Well, so much for Wall Street's big rally. After soaring nearly 550 points on Wednesday following the midterm elections, the Dow posted a modest gain yesterday. And of course, it's up more than 3.5% on the week. But we ask what's next for your investments. And we bring in Frances Newton-Stacy, Optimal Capital Director of Strategy. Good morning, Frances. Thanks for joining us.
Yes, good morning.
You know, I almost think that, the stage is set for stocks to rally in 2019 because look at what we put behind us. We put behind us the uncertainty of the midterms, and we also have a Fed who's very clear. We're basically hiking rates in December. So are stocks set to rally?
Well, they could if they can find some support, and it's important to take out the previous high, of course, from a technical standpoint. However, we have to remember that the Fed raising interest rates is actually putting a lot of pressure on the debt system, and we have record amounts of debt everywhere in the system, and the more that they raise those rates, even incrementally, it's harder to service that debt. So as long as the credit markets stay strong, then yes, I say that stocks are going to continue to rally. If those credit markets start to have problems, it's going to cause problems for stocks, and essentially, the Fed is reducing the money supply, so that can put pressure on stocks. So we'll just have to wait and see how slowly they do this and how big of an effect that they have.
What do you make of the almost record amount of S&P 500 buybacks, stock buybacks that we've seen this year?
Well, it's interesting. That's what happened in 2007 before the market high. But I think companies are basically incentivizing shareholders to hang on to the stock despite the slightly heightened volatility.
Instead of investing that money in their own companies and their employees?
Right. So basically, when they buy back the stocks, they're giving shareholders a larger percentage of holdings, basically. So it incentivizes shareholders to hold on to the stocks that are being bought back if they sell other stocks when you have a heightened volatility situation.
I also want to talk to you about oil because there seems to be a shift in the psychology that is affecting this market. It's now a bear market. I mean, it was, what, October 3rd. We were at a 4-year high for oil prices going to 80, and now we might drop below 60. What's going on with the price of oil?
So oil's kind of a bellwether for inflation and deflation, in my opinion. Basically, oil going down is not a good sign, and the Fed should be paying attention to oil going down because it means waning demand, and waning demand means a slowing economy. So I think in addition to seeing how the rate hikes affect the markets, I think that oil has to be paid attention to because it's actually a deflationary sign, meaning that the Fed's hiking rates and reducing the balance sheet is taking a larger effect than maybe they're anticipating.
You sound pessimistic here, Frances. You do.
I sound pessimistic.
Okay.
Well, every time the Fed has hiked rates in the history of hundreds of years of markets, they've sold off traditionally. So that's just sort of what happens when you reduce the money supply. The stock market is a liquidity meter, and it tends to, selling tends to come along with that.
Frances, thank you very much for joining us this Friday morning.
Thank you.